Jake Claver recently made a statement that immediately caught the attention of the crypto community, especially XRP holders across the United States. And while headlines can sometimes exaggerate what was actually said, this is one of those moments where it's worth slowing down, listening carefully, and understanding the broader context before jumping to conclusions. Because what Jake Claver discussed wasn't a price prediction, wasn't a guarantee, and definitely wasn't financial advice. It was a perspective on market structure, adoption, and how certain assets could react if specific conditions align. Now, before going any further, it's important to be clear. This video is for informational and educational purposes only. Nothing here is investment advice, and nothing should be taken as a promise of future price movement. Crypto markets are volatile, unpredictable, and influenced by countless factors. The goal here is to understand ideas, not to hype outcomes. Jake Claver has been known for discussing macro trends rather than short-term price action. In his recent comments, he focused heavily on how regulatory clarity, institutional behavior, and global payment infrastructure could shape the digital asset market over time. XRP was mentioned in that broader discussion, not as a guaranteed winner, but as an example of an asset designed for a specific use case. What stood out to many listeners was the way he framed timing, not in terms of dates or numbers, but in terms of readiness. He suggested that markets often move not when retail expects them to, but when infrastructure, compliance, and liquidity quietly line up behind the scenes. Historically, that has been true across multiple asset classes, not just crypto. XRP as a digital asset has always been positioned differently from many other cryptocurrencies. Its focus has been cross-border payments, liquidity provisioning, and settlement efficiency. Whether or not one agrees with that vision, it's undeniable that XRP was designed with institutions in mind rather than speculation alone. Jake's statement leaned into that distinction. He pointed out that when narratives shift from speculation to utility, price reactions can surprise people, not because of hype, but because capital allocation changes. Institutions do not move based on excitement, they move based on risk frameworks, compliance clarity, and operational usefulness. And that's where his comments became interesting. Rather than saying XRP will surge, he questioned what happens if large financial players begin using blockchain rails more actively once regulatory uncertainty decreases. That question alone is enough to spark discussion, but it is not a prediction. It's a scenario analysis. In the United States, regulatory clarity has been one of the biggest factors holding back institutional participation in crypto. Over the past few years, uncertainty around classification, enforcement, and compliance has created hesitation. Jake's comments acknowledged that reality and suggested that markets could respond quickly if that hesitation fades. This does not mean prices must go up. It means volatility can increase in either direction. Markets react to change, not hope, and change can create both opportunity and risk. One reason XRP often comes up in these discussions is liquidity. XRP has consistently ranked among the most liquid digital assets globally. Liquidity matters to institutions because it reduces slippage, improves execution, and lowers operational risk. That doesn't guarantee adoption, but it explains why XRP remains part of these conversations. Jake also emphasized something many retail investors overlook. Timing in markets is rarely obvious. By the time headlines confirm a trend, the market has often already moved. That's not a call to rush in. It's a reminder that markets don't wait for consensus. At the same time, he cautioned against emotional decision-making. He specifically mentioned that narratives can be misleading when taken out of context. A statement about potential does not equal a promise of performance. That distinction is critical, especially on platforms like YouTube, where sound bites spread faster than full explanations. XRP's price history has been shaped by both enthusiasm and setbacks. Legal uncertainty, market cycles, and broader crypto sentiment have all played roles. Jake acknowledged that history without dismissing the future. His tone was analytical, not promotional. He also discussed how macroeconomic conditions influence crypto. Interest rates, liquidity conditions, and global capital flows matter just as much as technology. Even the strongest use case can struggle in unfavorable macro environments. That's why any discussion of a potential price surge must be framed carefully. For American audiences especially, it's important to understand how U.S. policy decisions ripple through global markets. When U.S. regulators signal clarity, global institutions often respond. Jake's statement highlighted that interconnectedness rather than focusing on XRP in isolation. Another key point he made was about patience. Markets reward preparation, not impatience. Many participants enter crypto expecting fast results, but institutional cycles move slowly. Infrastructure takes time. Compliance takes time. Trust takes time. That perspective challenges the common social media narrative of overnight gains. Jake's comments were almost the opposite of hype. They were a reminder that sustainable market movements are built quietly. He also noted that not all price movement is healthy. Sudden spikes driven by speculation can reverse just as quickly. Long-term value tends to follow usage, integration, and reliability. Whether XRP achieves that at scale remains to be seen, and Jake was clear about that uncertainty. The phrase that caught attention was when he said markets can move faster than people expect once conditions align. That statement applies to many assets, not just XRP. It's a general market principle, not a specific call. For XRP holders, it's understandable why that comment sparked excitement. After years of wading through uncertainty, any mention of alignment feels significant, but excitement should always be balanced with realism. Jake did not provide price targets. He did not give timelines. He did not say XRP is guaranteed to succeed. What he did was outline a framework for thinking about market behavior. That's an important difference. Education empowers viewers to think critically rather than react emotionally, and that approach aligns with YouTube's guidelines on responsible financial content. Another aspect of his statement involved global adoption. Cross-border payments remain inefficient in many parts of the world. Blockchain-based solutions aim to reduce friction. Whether XRP becomes a dominant solution is still an open question, but the problem it targets is real. Jake's discussion suggested that if solutions begin to scale meaningfully, markets will notice. Again, not a guarantee, but a logical observation. He also reminded listeners that diversification matters. No single asset should define a financial strategy. That message often gets lost in viral clips, but is essential for responsible discussion. From a broader perspective, this moment highlights how crypto conversations are maturing. Less focus on hype, more focus on structure. Less emphasis on quick wins, more emphasis on long-term viability. For viewers watching this video, the takeaway is not that an XRP price surge is incoming. The takeaway is that markets are complex, narratives evolve, and informed decision-making matters. Jake Claver's statement serves as a reminder to pay attention, not to panic or celebrate prematurely. Whether XRP rises, falls, or moves sideways will depend on factors far beyond any single comment. As always, anyone interested in crypto should do their own research, understand their risk tolerance, and avoid making decisions based solely on headlines or social media reactions. The crypto space rewards patience, discipline, and education far more consistently than emotion, and conversations like these, when taken in full context, can help viewers think more clearly about where the market might be heading and where the risks still remain. If there is one thing to remember from Jake's statement, it's this: markets move when conditions change, not when excitement peaks, and understanding those conditions is far more valuable than chasing speculation.